Number one, welcome back, everybody. I consider this to be like an investor workout. This is our monthly workout because, as we know, investing oftentimes comes down not necessarily to the mechanics, but our behavior towards the markets and so on. Colin and Joel, good to see you guys. Colin, any opening remarks, or Joel, any opening remarks?
Well, this is the only time I get to work out during the month, so this is awesome. I love it. That's by choice, by the way, not by that's
By
not that I can't work
design.
out. It's just that I choose not to. So this is very helpful. But happy to see everybody on the call. It's one of my favorite times of the month.
Absolutely love it. Mr. Collins, throw you over the mic, buddy.
I'm pumped. No, this is it. This is why we do this. This is I think this is not my phrase. Matter of fact, I might have stole it from you, Wes, but like,
Probably
we
did.
often don't need taught, we need retaught. And that's a big reason for these roundtables, right? We constantly have to remind ourselves because we are flooded. There's no shortage of financial media, of ideas, of pitches, of products, etc. So it's always a great opportunity to level set, come back to the fundamentals, and remember why we're doing what we're doing.
Yeah, absolutely. And I think if you look at, let's say the 12-month returns, which by the way, that is a really, it's the heuristic that I like to use personally. Remember, we are buying enormous companies, which we're going to have a company deep dive session today about Coca-Cola. Um, it's to remind us that we are buying businesses. And if we get back to the basics, real estate, public companies, and private businesses, those are the ones that my personal vote is for long-term assets. Um, now, the only difference, well, a major difference between a private business and a public company is just the size and scope and the regulations around the larger business for investors' protection. Oftentimes, we can forget that though. If we look at the heuristic that I like to use, which is minimum a 12-month rolling period return, right? So I'm not just going to look at this week. I'm not just going to look at this day. And I obviously know this sounds obvious in our conversation, but it's not so obvious in common practice. I mean, how many of us, myself included, have been guilty of just pulling up our phone or whatever digital device we're looking at a random snapshot in time, the last week, the last month, the last day, and feeling negatively or positively about that. So in good times, I always want to remember or remind everybody, hey, we will have bad times again. And if we position everything correctly, those bad times turn into opportunities. And that's even if you're in retirement. So I want to show some graphs that Colin introduced, which was outstanding over the last couple weeks. And then, Colin, I want to get your commentary. Let me share my screen. Colin, let's throw the mic over to you, buddy. Walk us through what this chart in front of us means.
Yeah, so I have a couple observations here, but before we I guess get into that, just looking at the calendar year returns segmented by performance, right? So from left to right, we have bear markets, which are 20% or worse to the negative, right? You have lost money anywhere from 0 to 20%. So before you get to bear market territory, right? There's 20 of those years over the last about 100, right? Less than average, but still a positive year, right? So between 0 and 8% positive return, right? 14 of those calendar years over the last 100. Smack dab, essentially average returns have happened 6 times over the last 100 years. Better than average returns between 12 and 20%. That's happened 16 times. And then pretty crazy. Better than 20% in a calendar year, positive return, right? 38 times over the past 100 years, right? So a couple of takeaways. The first just being the obvious. There is far more good news on this chart than bad, right? But again, I think to our conversation just a couple minutes ago, what's all of the, or I shouldn't say all, but a lot of the financial rhetoric about, whether it be on Fox Business, CNBC, etc. It's typically the doomsday scenario that this time it'll be different, right? That whatever headline du jour of the day is, whether it's the AI bubble, whether it's tariffs, whether it's the presidential election, you name it, right? We could sit here for the rest of the hour and name financial doomsday headlines, right? Evidence, actual data, right, tells us a bit differently. But I think there's another far more interesting take, at least to me, from that chart, and that's that even though the broader market, the S&P 500, returns on average to that chart's point 10.5% per year, it actually only falls in average ranges 6 years out of the past 100, right? So it's very boom or bust. It's either we have a really good year, right? Or we're negative to bear market territory. There's very little in between, right? And this is really important in retirement planning, not as important in your accumulation years, right? Because you are funding, you're actually taking advantages of the downturns. You're dollar cost averaging every paycheck into your 401k, and you are actually a beneficiary of the volatility, right? But in retirement, your returns can be very boom or bust, right? And this is why it's so important to structure a durable portfolio to be able to weather the short-term downslides. Right? We talk about it a lot. I don't mean to sound like a broken record, but we need short and medium-term portfolios to hedge our bets because, again, our long-term wealth-generating vehicles, something like the S&P 500, is either going to have a year like last year, where we have upwards of 15%, or a year like 2022, or COVID or something like that, where it's down 20 to 30 to 35%. Right, so there's not a lot of dancing around the averages, right? And Wes, you say this oftentimes when we teach our classes. Averages can oftentimes be skewed. You put one hand in boiling water and one hand in the freezer, and you have like the perfect temperature. Well, on average, sure, but the reality of it is like one feels really good, one feels really bad, right? So if there is a word that I would talk about for a retirement portfolio, it would be durability. And if we can continue to increase our durability, to your point a few minutes ago, Wes, of taking advantage of downturns, not being vulnerable to them, right? You can actually become a big winner with the market volatility as opposed to not.
Yeah, I want to add to this because it brings up a really good topic. As we sort of alluded to earlier in the session, and let me see if you guys can see this right here. Colin, is that big enough for you guys? So oftentimes what happens is people talk about investment returns. They are talking about the actual return of usually the price fluctuation of a particular asset. And this is the starting step of where investors can make mistakes. What you want to think of is your investor returns. So investment returns differ than investor returns for several reasons. Now, also you want to be careful of the blended return. Right? So one of the problems is when we make a portfolio, remember, volatility mostly sits on the top level of portfolio construction in your long-term assets. Now, below that, you have medium-term assets and short-term assets. And the elementary example that we always talk about is, yes, if you put yourself on a surfboard in the middle of the ocean in 30-foot waves, if you're an unskilled surfer like myself, you just turn that volatility directly into risk. But if you're on a submarine, you are now several layers below the volatility. Now, each one of these types of assets is important. You need short-term assets, medium-term assets, and long-term assets. Now, the degree to which you need those is going to vary wildly, right? If Christina Smith, making up that name, has certain reasons that we need to stack her money in short-term assets, right? Those short-term assets might be right for her. Now, the returns will be lower there because the result that we're looking for is different. So we might just put a few dollars in medium-term and long-term assets. Now, the problem with blending the return, let's say in Christina's case, is the overall return for those might, let's just say, be 3%. Now, if Christina goes and watches some sort of show or talks to her friends and says, "Hey, Christina, you should be getting 20% on your investments this year. Why are you not getting that?" And Christina now feels FOMO from missing out, not realizing that the blended return of all of these can oftentimes be misleading for investors. What you have to do is actually look at each individual investment inside of each of these layers, if that makes sense. And is that vehicle giving me the result that I want? The return is a secondary conversation. Now, similarly, if we have a different investor, we might say, hey, this investor has mostly long-term needs. So let's stack all of her capital here. And that blended return might look outstanding. Let's say last year that may have been, 19%. Her blended return is going to look phenomenal, but that doesn't mean it's right for Shelly at all. So we have to think result before return, and then we back into the vehicles.
You mentioned a very important word that this is just a quick side trail, right? Volatility, which is really what people are typically describing when they bring up risk, right?
Yep.
I think it's very, very important to define those two things. Risk is the potential permanent loss of capital, right? Meaning that there is no recovering if it goes to zero, right? Volatility is deviation from the mean, right? We want volatile assets in our long-term portfolio. That's how you get a year like last year where you got 14, 15, 16% to the upside, right? Because it deviated away from the mean in a fun direction, right? So we have to accept volatility in our long-term portfolios to get the potential double-digit rates of return over a long period of time. But again, we really want to assign goals and time horizons to that, because if you need some of your long-term money next week, that overlap could become very problematic if it doesn't, if you don't get lucky, essentially, right? So I think it's very important to use the correct terminology, and it's our job as coaches to always realign the conversation and make sure that when we're talking about risk, it's appropriate. But when we're saying risk and we actually mean volatility, right, we're just trying to educate you on those two words, because it's very, very important for investor comfort, right? We do not want to take unnecessary risk if we do not have to.
And also recognizing how susceptible the human brain can be. We can all be to these natural fears, and then in the hands of a salesman rather than an educator and a coach, they can really amplify that feeling. Oh my gosh, Mr. and Mrs. Investor, how crazy is the markets? And they will use strong and hyperbolic terminology like, oh, it's just a matter of time until this market crashes. Like all of these very extreme terms that, if they catch you at the right time, can really take advantage of that vulnerability. So that's why we want to do it in the opposite way. Hey, during good times, let's actually remind everybody how tough the bad times can be. So that way we can expect it, we just can't predict it, as they say. So let's take a look at another chart here. And Colin, would love to get your take on it. The S&P 500 intra-year declines and the percentage of years in which that happens, and then happens every blank on average. So Colin, if you don't mind, walk us through this, bud.
Yep. Yeah. So how often does the S&P 500 go down by 1%, at least 1%? Well, 100% of the time, right? So essentially for the last 100 years, the S&P has been below all-time highs by 1% every single year, right? And then just commensurate as we move through this. So how often is it 5% below all-time highs, or to the price at which you began the year in, right? Well, 94, essentially every year, not quite every year, but almost every year, right? You start getting out to 10%. Now it happens less frequently, but still pretty frequent, right? Just about 63% of the time, every 1.6 years, you're going to get a 10% decline, right? 15, again, a pretty dramatic reduction, right? Now it's only happening 40% of the time, still often, right? But again, as it gets more and more severe, it happens less frequently, right? So we get down to 20, 25, 30%. Now you're talking 1 in every 4, 1 in every 5 years. 30% happens 1 every 10 years. 40 and 50%, you guys essentially seen this once or twice in your lifetime, right? Yeah, I think 50% for most of the people on the call happened a couple times this century, right? Depending on the century, depending on the index. I think before the tech bubble, you had to go back to the early 70s to recognize a 50% downturn, right? So the more dramatic the decline, the less frequently it happens. But again, to both my dad's and Wes's point, you can tune into just about any financial outlet that you'd like, and you're going to hear some pretty strong language around, potential fears that that they want to insert into your investor psychology. I think it's really, really important to look at the data, right? And start to benchmark your psychology around what actually happened in the past, not what marketers or salespeople say will happen. Um, it can get a little tricky when you start to use those words like, crashes, or, this time is going to be different, or anything of that nature, right? This is not to say there isn't legitimate fears. That's certainly not the case. And you're human. You're not a bag of chemicals, right? We understand this. We appreciate it. Matter of fact, we appreciate it at a pretty deep level. However, again, it is our job to coach through, right, the severity of these declines and what they actually mean to you, particularly for your retirement planning purposes.
Yep, exactly. And what we have to remember, again, this might sound so obvious, but let's pull up a visceral example. If you look at this chart here, right? Oh, sorry, let me I don't think I shared. Okay. So if you look at this chart, if you just play with the charts, right, you get dramatically different visuals. Here's the 5-day visual, here's the 1 month visual, here's the 6 month visual, here's the year to date visual, here's the 1 year visual, here's the 5 year, and so on and so on and so on. Well, if you look at that, let's look at the max visual and you look at the trend, right? But if I were to zoom in on any one of these days, it's very choppy. Again, this sounds so obvious, but what happens in common practice is we will see this at a random point in time if we just choose to wake up one morning and look at our holding, and it might be down. It might even be down when you purchased it 3 years ago, right? 4 years ago. Every once in a while that happens if you look at a major downturn like a COVID or a tech bubble or a of 2000 or a Great Recession of 2008. That happens, but remember, you're not owning the price. You are owning the actual company. Very, very, very important. It's just so easy to forget that. It's like, oh, Coca-Cola, which we'll expand on here in a bit. Coca-Cola, there's a reason it has value. Different than the banana that we talk about all the time, that silly banana that was duct taped to a wall that sold for $6 million or whatever it was. Very hard to articulate the value of that banana. Very, very hard. Pretty easy to dictate the value or articulate the value of a Coca-Cola. So let's hop into the next graph here, because I think this was pretty interesting, because there's one component which is the asset side. And what we have to remember is the expense side. As we are in retirement or just in everyday life, we are spending money. We are burning through capital. And even if we're not spending it, inflation is deflating, is basically deteriorating that purchasing power on a monthly, if not daily basis. So let's actually look at expenditures by age. And Colin, let's get your intro here, buddy.
Yeah, I love this. I love this chart because it's just a visual representation of expenditure by age. Now, this is averages. We kind of already given disclaimer on averages, and certainly if you're in Ohio versus Southern California, this is probably going to look a lot different for you, right? So it's very context dependent, but it is an interesting an interesting chart, right, by decade essentially of what your average expenditure is, right? Most people on the call, anywhere from, let's call it 45 or 50 to 70, 75, typically, right? We could see on average expenditure peaks midlife, right? Anywhere between 45 and 55, right? Starts on a steady but slow decline over time. I think what the chart doesn't do a great job of representing is at the end of life, typically medical expenses can really jack up your expenditures, and not for the most fun reasons, right? But this is again a decent way to help plan against the other side of the ledger, right? Which is, hey, we were talking about the assets a few minutes ago, but now we're talking about the outflows, right? What you're spending that money on, and it does typically seem to be on a downward trend in retirement, again, out until that last little portion of life where medical can can in some cases dramatically increase expenditures. You've probably all heard the story, but certainly true for my great aunt. She spent essentially nothing throughout retirement, but the last 4 years of her life, from ages 98 to 102, she saw something close to a 400% increase in expenditure because of long-term care. Right. So
Yeah.
again, that's not well represented on this chart, but I do think it's a pretty stunning visual at expenditures by decade.
And I'm going to push on this a little bit because I do think on the coastlines the story could be different.
Yeah. Oh,
Uh,
yeah.
Um, and Colin and I over the weekend just played pickleball with a couple, and they some features of their face would indicate that they were in their 60s, but the rest of them moved like they were in their 20s. This was
they kicked our
insane.
butt.
Yeah.
Oh, they whooped us. Actually, yeah, we didn't win one game, which is, I was hoping Colin wouldn't bring that up. But I have seen for certain families almost the opposite, where like I could give story after story where the family in their 70s, husband and wife in their 70s, are now spending more. It could be a result of gifting to kids, could be a result of we're going to spend 6 months on a cruise now, could be a result of, and I had to deal with this recently, hey, I've got this aging real estate portfolio. I'd like to make modifications to it before, God forbid, I can't or I pass away so that my kids don't have to deal with it. All of a sudden, we are influxing hundreds of thousands of dollars into those assets. That was not predicted in the past. So, again, getting back to the conversation of averages oftentimes can skew the story, it has to be customized for you as the family.
And I know it doesn't sometimes feel this way, right? But the people on this call, and the people that we work with, are skewing the averages to the upside, right? Not the downside. So you guys tend to spend more, right? Which is a great thing, right? You have the resources, you have the capital to spend and go do fun things, right? But again, just be the cautionary tale of like those are averages, meaning everybody on the socioeconomic scale is taken into account there, not people that have done well over time and put millions of dollars away in a 401k, or are smart enough to live on the coastline in Southern California, et cetera.
That's right, buddy. All right, now I'm going to change gears a little bit here because I oftentimes get this question. I just got it recently, so it prompted me to look up the data, where a client is asking, "Hey, I'm in the market for a car, and I almost want it to kind of be my last one or last-ish one. I just don't want to have to deal with, right, like a car a couple years from here. What's the most reliable?" So I looked up some data I thought was interesting from from the Visual Capitalist, and this to me was no surprise. Again, I know this is kind of a weird topic to bring up, but I get this question a lot. Toyota at the top of the list. Is that Subaru? I think Subaru is that, the starry kind of logo. And then Lexus, Honda, and then BMW. It's a bit of a fun chat, but I want to open this up. Toyota, oftentimes our clients who have Toyotas, man, I mean, I had a Lexus at one point that Dave actually gifted to me. I drove that thing until 209,000 miles, which Lexus and Toyota, same company. And then I gave it to a friend, which he's still driving it. I mean, it's just insane. So for any of you who are interested, but Colin, I know this is a lighter hearted topic, but what's your take on this? Do you agree with this?
Not a ton on the upside, but could you scroll back down to the bottom of the list?
Yep.
Yeah, okay. Yeah, so a ton of the American brands,
At the bottom.
just
Yeah.
just filling up the bottom. Yeah, yeah. We do not do a great job in this country of automation, do we? Or I'm sorry, building the automobiles.
Yeah,
Yeah,
I mean, Toyota, my mechanic said to me a while ago, he's like, when's the last time you saw a Toyota on the side of the road?
that's a
Unless it was like a pop
It's a
tire or
great point.
something.
Yeah.
yeah,
Yeah.
that's a pretty strong point. I know that these can get into like tribal wars of like
Oh, yeah.
who the car. I don't have any car bone in my body, so
Yeah.
it's tough for me. But I do think it is a great conversation to have, Wes. I appreciate you pulling that up. I can think on 3 occasions in the past month that I've gotten asked that same question. So you guys are not alone out there. You know, we would prefer to get these questions as opposed to not. So
Yep, 100%. All right, now let's go into company deep dive corner. Again, this is not a formal recommendation. We just like to explore the actual businesses and the business models that a lot of our investors are, including myself and Colin, are invested in, because we invest in a lot in funds and ETFs and so on. So there's a lot of companies inside of there, and very rarely do we actually break it open and say, hey, let's zoom in on the business model of something where our dollars are actually buying those companies. So let's take a look. Today, we are going to look at Coca-Cola, which is a fascinating company. And let me pull this up. And then, Colin, if you don't mind, can you see this, buddy?
yep.
All right, let me see if I can run the slideshow. All right, cool. So let's hop into it. Number one, if you just look at how durable this business model has been. Started in 1886. It was originally created, I believe, as a medicinal product. Very fascinating. In 1919, Coca-Cola goes public. An original share would be worth millions today. In 1982, Diet Coke was introduced, becoming the first extension of the trademarks. And then 1985, New Coke was launched and quickly reversed after consumer backlash, which I've got some comments on that. And then today, total beverage company with 200 plus brands in over 200 countries. This is also the thing. When we talk about Coca-Cola, oftentimes people think you're just talking about the actual product of Coca-Cola, not realizing that there are many different products that they have. Let's go from here. Total beverage portfolio, sparkling hydration, coffee and nutrition products, etc. Here we go. Dividend King, 62 plus years, which is really fascinating. So Coca-Cola has increased its dividend for over 62 consecutive years. What is really fascinating is the uninterrupted dividends that it's paid, meaning it's unbroken streak, even during downturns in markets, that reliable cash flow is still there. This is one of those things that we talked about oftentimes. If invested in the right equity positions, oftentimes people completely negate or discount the power of the equity income, which in this case would be a dividend, and relating that to a bond yield. Remember that bond yields are reported as and are paid out as simple interest, versus dividends are reported and are paid out as basically compounding interest, because it might be 2% this year and then 2% next year, but it's 2% potentially on a higher valuation. And then always fun fact to remember, dividends are paid per share, not as a percent of the value. They're just reported as a percent of the value. Now, if you look at Coca-Cola, let's look at its revenue trends. I think it's important to highlight actually when 2020, when it was down, which to me is not a bad story. It's showing, hey, look at what it did in 2023. These companies are specifically designed to produce money by selling goods and products. So if they have a bad period of time, trust me, their executive team is, first of all, it's on the firing squad, right? Like if they do not turn the company around, then they will be replaced. I know that doesn't sound very nice, but these companies are designed to increase valuations over time. Let me pause there. Actually, let me get through this one share and then I'll slide and then I'll hand it over to you guys. One of the world's most recognizable brands. Its mind share, 94% of the world's population recognizes the Coca-Cola logo, which, fun fact that I heard not too long ago in a casual conversation, from my understanding, Coca-Cola has sponsored watering holes in villages that do not have any sort of stabilized economy yet. They want to insert the branding so that when those villages eventually escalate into a workable economy, that they already have Coca-Cola's brand image in its mind. That is how rooted Coca-Cola is. And then also their emotional connection via marketing. I mean, I would imagine a lot of people link Santa Claus with Coca-Cola because of their ads during Super Bowls, their ads during Christmas time, etc. Guys, let me pause there. Let me throw it over to you, Joel. What's your first commentary here, buddy?
Well, it's definitely the advantage. They're playing the long game, certainly. I mean, digging wells and putting Coca-Cola sign over the top of that water well in underdeveloped countries. That's thinking, that's forward thinking at its best. And then I did read this morning an article that it is now the 63rd year that they've increased that dividend.
Love
So
it.
the trend continues.
Colin, what's your take, buddy?
How incredible that 94% of the world recognizes that brand. That is
Insane.
like, I wonder who else is even in that conversation. I have I struggle to think of companies that like quickly come to mind that would be in that same category. I'm sure we can think of a few, but it has to be a very short list, right? That's a pretty incredible stat. But another quick anecdote. Oh, yeah, here we go. I was just about to talk about Warren Buffett, but go ahead, Wes. What are you going to say here, and then I'll add to it because I have a little evidence from Warren Buffett and his investment in Coca-Cola.
Yeah, I think as in true Warren fashion, he just always has a way of simplifying down, probably tons of data and analysis. And his quote is, I think, is outstanding. If you gave me $100 billion and said, take away the soft drink leadership of Coca-Cola in the world, I'd give it back to you and say it can't be done. And Warren often talks about moats. And one of the mental models he uses is saying, hey, if you gave me X amount of dollars, a very large sum of money, could I even create a dent in that brand? And if the answer is no, I'm out. Colin, go ahead, buddy.
Yeah, so I came across this the other day, actually, ironically. They when they made their big purchase back in the mid 80s and invested in Coca-Cola, they bought 400 million shares at the total price was about 1.3 billion dollars. They've received over $11 billion in dividends since that initial investment, right? So just on the return of cash via dividends, right? They have essentially 10x'd, right? Their original investment. That does not include the price appreciation over that time, right? So again, I know we sound like we're a broken record talking about cash production from your equity assets. But do you think Warren ever wakes up on any given day worried about the price of Coca-Cola when he's receiving literally hundreds of millions of dollars in dividends annually? No, and I sometimes get pushed back on that. I was like, hey, I can't be Warren Buffett. It's like you don't need to be Warren Buffett. Just emulate the model on a personal level, right? And do it relative to your own expenses, right? You don't necessarily need to be a conglomerate like Berkshire Hathaway to be able to copy that model successfully.
Yeah, and a couple of fun facts here. I'll read down the list. From my understanding, originally Coca-Cola was sold for 5 cents, and that price stayed unchanged for nearly 70 years. Um,
Whoa.
I believe this is true. It once contained cocaine,
Yes, I think
which is
you're
pretty
right.
interesting.
Mhm.
Yeah. The logo is over 135 years old, which is crazy. In the 1930s, apparently it helped shape the modern visual of Santa Claus, which is fascinating. Sold in over 200 countries. And here's a huge one. Roughly 2 billion servings are consumed daily. I mean, imagine a product where you're basically making sugar water, right, and different versions of it, and you're selling over 2 billion servings per day. Now, Warren Buffett talked about this a lot, where Coca-Cola has something called zero taste memory, meaning that because of the ingredients, that you can consume it and then your brain forgets the taste very quickly thereafter. So if you imagine this versus orange soda, you probably don't know many people who are kind of addicted to orange soda because you have a certain amount of it, and probably after 10 ounces, it's kind of like a lollipop. You're kind of done. Versus I literally know people who drink many, not just multiple, many servings of Coca-Cola's products per day. I don't know how they do it, but they do it because of that zero taste memory. So just a fascinating business model. Colin, anything else to add to this, bud?
Well, it's also like to the conversation about the brand. I mean, I would imagine everybody on this call knows people who are diehard Coke fans, right? Like they have to have a Diet Coke, right? And if you say, hey, we only have Pepsi products at this restaurant, it's just a non-starter for them, right? Which is again pretty fascinating, pretty interesting that they have that they've cemented themselves as the go-to drink in countless households.
Yeah, exactly. Joel, anything else to add, bud?
Yeah, so I've got to your point about being the brand. Last year, I went to a luncheon, a business lunch, and the keynote speaker was his name slips my memory, but he owned the largest Coca-Cola bottling company in America. So I mean, he was not hurting for money. And then he took some of that money, and his son became a missionary. And so he funded a lot of missions and went with his son on into all these remote places in the world. And he said there was not a place they could go that they said, if they asked him if they wanted something to drink, they said, "Hey, do you happen to have a Coke?" And he said it may have taken him 20 minutes and they bought this bottle back that was covered in dirt or, whatever, but they had Coca-Cola no matter where they went. It was unfailing. They asked for Coke and got it. So it's
Yeah.
an
I mean,
incredible story. Yeah.
it just speaks to the density and the distance of that moat around the castle.
Yeah.
Around the castle. I mean, it's an unbelievable, in my opinion, unbelievable business. Again, that's not a formal recommendation, but just an
Yeah.
amazing case study on how big businesses can get and keep on getting larger. What we have to remember is, in this little country we call America, we have a head start compared to a lot of countries when it comes to capitalism. There is still so much more room to grow. I mean, although Coca-Cola is selling in 200 countries, there are more people that they can serve. So, anyway, guys, thank you so much. If anybody has any questions, please let us know. We're here to serve you. It's an honor to do so. And thank you all for showing up on a monthly basis. It really is a pleasure for us.
Yeah, we appreciate all of you. Thank you so much.